So one of the questions that we get most often from potential clients is, how do you charge? And advisors charge many different ways. So today we're going to cover how advisors charge for their services.
Yeah, so we're going to talk about 4 ways today: commission, hourly, assets under management, and then flat fee. Let's start with commission.
This was the way financial services initially started. You're paying for a one-time service.
Yeah. You commonly see these fees nowadays on products like life insurance policies, on annuities, potentially on some mutual funds.
Today it's anywhere between like 1 to 5.75% on mutual funds. On an annuity, it's often maybe up to 10% or more.
But what are the pros of paying a commission?
Well, the pro is if you only need advice that one time, you're paying most often a one-time commission. The problem is that because the price of the commission is often built into the product, effects on the return could last for years. And that's important to understand, because let's say you purchase an annuity that there's a no commission version, and for example, you can get up to a 12% return. And there's a commission version, and because of the commissions built in, you can get up to a 9% return. So that first year you could say, well, someone helped me choose the product. But in future years, that can compound into a really large difference in returns.
Yeah, so that's one of the potential conflicts that you run into. Another potential conflict of commission-based is potential for churning. Churning is when the advisor will sell you an additional product off of anything that they might have already sold you to collect another commission. In many cases, when you're trying to look for something like a life insurance policy and you just need that one-time general guidance, I think paying a commission's fine. But it's important to know that there's that conflict of interest there.
There's one big difference between the commission-based advisor and the other 3 advisors we're talking about today, in that commission-based advisors aren't necessarily fiduciaries. So they don't necessarily have to put your interests first. They have to try to make sure that the investment is suitable to you, but they don't have to make sure that it's the best investment for you, or that they put your interests ahead of theirs and their commission. Commission-based advising isn't a bad thing. It's just that you should understand what you're getting for the commission and if that truly is in your best interest or not.
So now let's move on to hourly. So what is an hourly financial advisor?
So hourly advisors, if they're registered investment advisors, are considered fiduciaries. So if you have a certain number of questions you want answered, you can sit down with them, and they may charge somewhere between $150 or $200 an hour up to maybe $400 an hour or more. You can also go to them for specific projects. So if you want to do a college plan, a one-time retirement plan, or a debt consolidation plan, but it's not going to provide ongoing advice unless you want to pay that hourly fee ongoing.
So paying an hourly fee is probably good if you do have a small, limited scope or one-time project, like you said, like debt planning, college planning, a one-time retirement plan.
If you have a project that you know is defined short time, so your kid's going to enter college and you need a plan to help you figure out how you're going to pay for that, or to help fill out the FAFSA form, or you have someone who has a pension decision to make, and that's the only advice they need. They don't need a full comprehensive plan. Going to an hourly advisor could actually be a benefit, because maybe that process only takes 4, 5, 6, or 10 hours, and now you know that you pay that fee. You don't have a long-term engagement with a particular advisor, but you've gotten your questions answered and you can kind of move on.
But there are some cons to this model as well. So what is one of the potential conflicts of interest that you can run into when it comes to working with an hourly advisor?
So there's something called scope creep. So that's something where you have an advisor and they kind of extend the amount of time that it takes to do the project in order to make more revenue.
Yeah. Also, hourly could potentially deter somebody from going back to the advisor and asking lots of questions, because those are billable hours for the advisor. If you need clarification on that one-time retirement plan or the one-time financial plan or your college plan, you'd want to be able to go back to that advisor comfortably and have a conversation with him to further explain the plans.
So long-term projects, probably not great. Short-term projects, may be worthwhile.
We talked about commission, we talked about hourly. Now one of the most common fees in the industry right now, one that a lot of you might be familiar with because maybe your advisor charges this type of fee, is an AUM fee.
Right. Which stands for?
It's assets under management. So basically the advisor earns a fee on a percentage of your assets. So let's say it's a 1% fee. It could range anywhere from 0.5% to 1.5% to potentially 2%.
The average advisor on a portfolio that's under $1 million charges somewhere between 1 to 1.5%. And then for portfolios that are, say, $1 million to $2 million, we've seen 1% to 1.5%, usually about 1 to 1.25%. And then as you approach the $5 million mark, that's where you see advisors who are generally charging somewhere between 1%, maybe down to 0.85% or 0.5%.
Traditionally, if you're working with an AUM advisor, you're really only looking for investment management. Some advisors who charge an AUM fee might also provide financial planning or maybe tax strategy, but typically people would look for an AUM advisor just to manage their portfolio. I think one of the pros of this model that can also be seen as a con potentially, and we'll talk about that, is that the advisor does better when the portfolio does better. So you might have heard the phrase, we do better when you do better. And that's a potential positive depending on how you see it. The advisor is incentivized to do a good job managing your investments because they'll be paid more as your portfolio grows.
Right. Now, the flip side of that would be a potential negative, is that if the advisor makes more money as you make money and your portfolio goes from 1.5 million to 2 million, and instead of paying $15,000 a year, you're paying $20,000 a year, is the advisor doing $5,000 more work for you at that point in time? And if not, we do better when you do better means basically we're charging you more because you have more, which doesn't make a lot of sense.
Sounds like a wealth tax.
It's a wealth tax, exactly. Another potential negative is if you want to take that money out in order to invest elsewhere, that advisor is incentivized to try to tell you that it may not be a good idea and that to leave the money at that firm is the best idea because otherwise that advisor's income is going to get cut.
But the AUM advisor fee is still a great way to pay advisors depending on your situation. For example, if you have a smaller or mid-sized portfolio and you're just basically comparing costs, the 1% fee might be significantly less than what you would pay a commission if you compound those returns over time, or even potentially what we'll talk about next, which is flat fee.
So the next model is the flat fee model.
So you could compare it to sort of like paying a subscription fee, but basically you pay that subscription and you get, let's say, financial planning done, and you get tax strategy done, and you also get investment management done just for that one flat dollar amount.
Yeah. Now, the caveat is that some advisory firms say that they have a flat fee financial planning, but then they also charge a reduced investment management fee to manage your investments. And then they also collect a commission in some cases as insurance agents if they sell you an annuity or insurance policy.
Yeah.
So we're talking here about purely flat fee.
Yeah. And the flat fees, I mean, since this is a very new model, the flat fees range drastically. So you can see firms that are charging a $3,000 annual flat fee for financial planning, for investment management. But then again, you can also see firms who are providing significantly more services but are charging a larger flat fee.
$30,000, $40,000, $50,000. Family offices, they might charge $100,000. So something to consider with the flat fee is the range of services that you're getting for the fee and what's guaranteed or not. A comprehensive financial planning relationship lends itself to a flat fee, right? Because you want an advisor to look at your cash flow and your debt situation and your tax planning and your risk management and insurances and your investments, as well as kind of everything in between. Anything that touches your personal financial life is what you want someone in a flat fee relationship to be able to provide advice on.
Yeah, so the pro is clarity. You know what you're paying for, you know the services that are listed, and you know exactly how much per month or per year you're paying.
I mean, one of the things that's always I thought was interesting about the AUM fee is if you go and meet one of your friends and they say, well, what do you pay? You could say 1%. But if they say, well, how much was that? You really don't know because the fee changes each month or each quarter as they calculate your account value,
Yeah.
right? With the flat fee, on a $15,000 fee, you're paying $1,250 a month. So whether you've got 2 million or 1.5 million or 1 million or 3 million, if someone says to you at any point in time, what are you paying? You could say, well, I'm paying $15,000 a year, or I'm paying $1,250 a month. It doesn't change. So you have a fee certainty that you didn't have with the AUM advisor.
The con would be that if you're only really looking for one thing like investment management, or you have a smaller portfolio, then the flat fee might not be worth it depending on how much the flat fee is, because the flat fee includes all those other services, which means that you're paying for services that you're not using. So real quick, I just want to show a comparison between AUM fees and the flat fee.
So client number one is an asset under management client, and we're going to compare that to client number two, which is a flat fee client. Both have portfolios of $1.5 million. We're going to assume a return of 7% for each, and the asset under management client is paying a fee of 1%, while the flat fee client is paying a fee of $15,000. And we're going to look over a 15-year time frame. So as we can see in year one, the portfolio value for both ends at 1.6 million, and the fee for the asset under management client is 1% or $15,000, and the fee for the flat fee client is also $15,000. So they both end with the same balance. So what we see over a 15-year time period was that client number one, which is the asset under management client, paid a total of $349,000 in fees and had an ending portfolio balance of about 3.6 million. Client two, who paid a flat fee, and even if it increased by a cost of living expense of 3% per year, at the end of those 15 years, paid $279,000 in fees with an ending portfolio value of about 3.7 million. So if you want to know why there's a difference in fees paid, yet a portfolio value that's more, it's because by paying less fees, there's been more money to compound and grow.
So since flat fee models can range drastically of the services they offer and the prices, we'll give you an example of kind of how we charge a flat fee and the services that we include with that fee.
Ours is what I consider a truly flat fee model. So when a client comes to us, they get a range of services from financial planning and cash flow to tax planning, risk management, investment management, and estate planning. Whether or not we manage some assets, no assets, all the assets, the fee doesn't change. So there's no additional asset under management fee. There's no commissions for insurance products or anything like that. We provide all these services for one flat fee.
Yeah. So again, it's very clear as to what you're paying for. So let's say it was $15,000 and you knew that these were each of the services that you were getting for that one price. Now you can see here's the value in that service, right?
Yeah.
So what are some of the unique parts of our flat fee model?
We call ourselves a client's personal finance CEO. What we've seen throughout the years is that your banker and your insurance agent and your attorney and your tax guy, they all want to do the best job. But I think what happens is all these professionals work in silos. So your accountant does your taxes, but he really never talks to your financial planner. And your financial planner never talks to your property casualty agent. And nobody talks to the attorney besides the client. And so the client's the chairman of the board. And then we're the personal finance CEO. And we help coordinate among all those other professionals to cohesively put it into one comprehensive financial plan. Not that the client can't talk to all those other professionals, but there's also someone who's helping make sure that they coordinate with each other on behalf of the client in order to work as a team to make the client's life better.
And I think that one of the reasons that we like the flat fee so much is that this model can sort of turn into like a family office for the mass affluent.
So if you've got 20 million, 25 million or more, they often hire an advisor to really help coordinate all these things that go on. And we've been creating that model for people who have anywhere from, let's say, $1.5 million up to about 10 million or more. Beyond the coordination, what are some of the other benefits of the flat fee model?
Well, you get advice on all your assets. For example, I'm going to compare this to the AUM advisor. The AUM advisor typically would only provide advice on the portfolio that they manage. They might occasionally provide advice on like a 401k, but really the incentive for them is to have that 401k rolled over to an IRA that they can manage. So the flat fee advisor doesn't have that same incentive. Therefore, we can provide advice on all the assets unbiased. So we can provide advice on the 401k, and maybe if the 401k has good investment choices and very, very low fees, we would tell the client that, hey, you can keep your funds at the 401k. We don't need to manage them.
We've got a lot of clients who have real estate, rental
Yes.
properties, and investment properties. And so we're not trying to get them to sell those investment properties to invest with us. We're trying to get them the best advice on the rental property. So we'll help them with cash flow analysis. Or if they're doing a 1031 exchange, we'll help evaluate the exchange deal, right? I mean, our goal, because we don't get paid more or less, whether we manage the assets or we don't directly.
Yeah.
So our goal is really to provide the best financial advice, including overall investment advice, to make sure that the client is better at the end of the day than what they started with.
Exactly.
Right?
Yeah. So there are positives and negatives, like we've said, to each different type of way that you could pay a financial advisor. It's important that you know them and you understand the different conflicts of interests and what fee might suit you best. But I hope you enjoyed this video. If you like this video, please like and leave a comment below which type of fee you would want to pay your financial advisor, and subscribe to the channel for more content like this.